Cool word.
Cool word. So if you can, you will avoid it. It's messy.
That doesn't sound so good.
Kind of a creative solution. It's horrible, stay away, they're vultures.
That's why you need to be a bit careful.
A claw.
It sounds a bit dramatic.
You put in 100 million and you get 200 million back.
Welcome back to Business Law Toolbox, and in this episode we are powered by the LE Fitness, which we are very, very happy about.
Yeah, amazing.
Amazing. And today we're going to talk about venture capital. How do you go from brilliant ideas to master billion businesses? And this episode is for you that might want to learn about venture capital and make a career in it, but also for you as a founder. So we have Kat today here with us that's going to explain it to us as usual, which we are very proud of.
Hello everyone. And this is the first of a masterclass.
Yes,
Yeah.
So this is the Venture Capital Masterclass, and we will welcome to that one.
Yeah, so if you find this too basic, skip this first one. In the following segments, we'll do deep dives into each issue.
To each issue.
Yeah.
This sounds really good.
Exactly. But today we're going to give you the basics, what you need to know, and it will be helpful, like you said, to you founders seeking that investment, understanding the dynamics. What are venture capital firms all about and what are they looking for?
Yes, and how does everything work?
Yeah.
And also remember, this is not legal advice, it's knowledge sharing as usual.
Indeed.
And talking about venture capital, it's a very sexy word. I mean, everybody wants to be a part of it, and it's a big thing to do.
Oh, yes.
So that's why we're going to explain it now, to just take it apart.
Venture capital is the hottest. And I mean, the successful founders typically move on and start their own venture capital VC firms. So that's kind of, wow, being a partner of a VC firm.
Yeah, that sounds so cool.
Yeah.
But if we start venture capital, what is it?
Well, it's high-risk capital. And we have a series about angel investors.
Yes.
And in that case, if you're an angel investor, you take your own money and invest it into a startup. A venture capital firm gathers other people's money and the manager invests it in a startup.
Oh, so you collect different...
Yeah, it's a pool of investments. And it's bigger ticket sizes as compared to the typical angel. So it's kind of the next level in the startup journey.
And that's why it's so much money in venture capital, because there's a lot more people involving.
Yeah, and bigger investors. The investors are typically institutions, family offices, more professional investors. So huge money. And what you should also know is that this pool of investment has a limited time span.
Okay.
So it doesn't go on forever like an evergreen, an investment company. The manager, the fund manager, they raise capital, just as you as a founder would raise capital. They go to their investors and say, we want to raise for a new fund. They raise the capital, and the fund will have a lifespan of 5 to 10 years. And in that lifespan, they promise their investors that they will, number one, deal source, find the best opportunities, startups and scale-ups. They will support in some way. Some VCs are more hands-on and some are not. They will support that startup, that company, so the value grows, and they will make an exit. So they get the return of investment.
So that's a part of the strategy.
Yeah. And of course, ongoingly, they will raise new funds. So this is kind of a ever-going wheel where they have fund number 1, fund number 2, fund number 3. So what you should know also as a founder is if you bring on VC money, the clock is ticking.
Wow.
And they prioritize growing, not black numbers, not making profit. They want to scale, grow, and then they can make that exit either through a sale or an IPO, going on the stock market, or something else.
So it's like a fast-forwarded fund.
Yeah, it's intense.
It's really intense.
Yeah. And if you look at the structure, you should also know the lingo always.
Which we have some episodes about.
Yeah. And in this case, you should recognize the LP, that is the investors. They're not part of the management of the fund. They invest their money, and of course, they have an investment agreement where you set some kind of rules, what type of investments you're focusing on, how you will split any profits, return of investment. But they're not part of the picking of the companies and the supporting of the companies. That's the GP, the general partner. That's the fund manager who runs the show. He's responsible from fundraising to deal sourcing to supporting to exit. And most typically, you will support by way of being part of the board of directors and other networking, stuff like that. You will not be operative, not that hands-on. So, but different VCs have a different approach.
Okay, so this is more like a short-term way of investment than the angel investment, you would say?
Well, angel investors also want an exit, but since you invest earlier, you should expect 10, 15, perhaps 20 years. But so the VC is tighter and more intense, yes. So it's higher risk because they will not let you as a founder or angel invest at an okay number. If they invested at a valuation of 200, they might want to see 400 or 600 or 800 before they accept an exit. While you as a founder, you might have been happy already at 30 million. So big chance of getting super rich if you make it. But the requirements along the way, because VCs calculate that most of their investments will fail or not make it, but they're looking for that really one, hitting it big. So it's tough as a founder, but also a great opportunity, of course.
Yes, but I think also that the venture capital comes in and have a lot of power over the company.
Yeah.
Because they have the big money.
Yeah. And that is, of course, also dependent on how attractive you are as a startup. If venture capital firms are competing to get into the investment, that will, of course, mean that you have more of a say-so. But the VCs have a strong opinion, absolutely.
Yeah.
And then the famous, how do you get rich?
Yes,
right?
Of course.
And there is a typical model where when you have done the exit, so you're closing down the funds, you can either distribute each time you make an exit, or you can calculate everything at the end as a whole. But regardless, number one, the LPs, the investors, will want the return of their money, so kind of preferred right, and then they want a hurdle rate. They want perhaps 8% before you as the fund manager get anything. And then you have a catch-up, but we can get back to that in the episode where we dig deep into the waterfall. That's details right now. After that, you have the world-famous carried interest.
And what is that?
That is when the LPs get their monies back and their preferred return rate, then you split 80-20. So the investors, the institutions and so forth, they get 80%, and you, the manager, get 20%. So imagine that you raised a fund of 100 million, and when you exit, it is worth 300 million. It went brilliant. And then you give the money back, 100 million, and then you say a preferred rate, it ends up being 25. And then what's left, 275, you split 80-20. And the fund manager, the GP, that might be 3 partners looking to split those millions. So that's why everybody wants in on venture capital, because you get really rich from the carry if you're a profitable fund. And imagine doing that again and again each time you raise a fund. So being a partner of a VC is kind of like, you don't have to take that individual risk on each startup because you spread the risk among several startups. And you utilize other people's money. But if you hit it big, woof.
You hit it really big.
So that's a lot of people's dream, really.
But you hear a lot of success stories when it comes to venture capital. It must be uncommon that it fail.
Oh, good question. I would say no. It's depending if you're talking about one or a few investments or if it's the whole fund that fails. And it's not super transparent. The numbers, when you look at kind of what was the return, how much dry powder do they have, how much did they raise, it's not as transparent as many other financial industries. So it's a bit hard because you tell what you want to tell, right? And often you have the fund located in what we typically call a tax haven. So that can be kind of hard. But I can say that when you raise a fund, if you want to go into venture capital, number one will be your track record. Have you done it before? Or have you founded a company that's done a major exit? And another thing is, do you have access to capital? Do you have the network to fundraise? And do you have the access to the startups? So that's really important.
So things you should think about before entering.
Yeah.
Like requirements or things you have been done for. Okay.
You have to have a thesis, a pitch. You're going to fundraise. Just as the startups are fundraising to the VC will be out fundraising from their investors. So they have to show, why should you trust me with your monies? Because the money will be locked in for a long time.
Okay.
And I can add, because that's also nice for you to know, is that when you close the fund, let's say you're a big insurance company and you say, okay, I'll put 50 million into your fund, dollars. Then you do not send the money to me directly. You commit that capital.
Okay.
And then once I have deal sourced and I find that perfect investment, I call on the money. I say, now, all of the LPs, I need 5 from you and I need 10 from you because that's proportionate. And I do the investment. So it's a committed capital. It's not that you send it and they sit on it. It's when they can deploy it that you send it.
Okay. Yeah. But you're still a part of the venture capital as a
you
investor.
have committed it.
Wow.
Yeah. And what more? Yeah, when we talked about starting new funds, that can of course be a conflict of interest, because if you paid me 50 in fund number one, you don't want me to be out fundraising when I should be out investing and utilizing your money. So typically our investment agreement will say that you can only fundraise again once you have deployed 80% of the capital in this fund. Because you want to save some monies both for new opportunities but also for follow-on investments so you can support companies.
But are there any big risks to join a venture capital? It's a lot of money, so...
Yeah, and you want skin in the game also from the partners. So typically there's some up and some down. You have to commit something and you have it's a long game. When you start off, you have to wait for your first return of investment for 6-10 years perhaps. So, and it's a tough game, really.
Yeah, I can hear that.
Yeah.
I can really hear
that. It's not for the weak-hearted. It's intense and you work day and night.
Yeah, it seems like it's very intense.
It is.
So, hopefully people will have some more information to start.
Yeah.
But what is the absolute first thing that you would recommend to someone to be a part of the venture capital career?
Oh, get a business education, do a startup, start from the ground. Do the hard work.
Yeah.
Competence attracts, and many VC firms are very open for diversity and different backgrounds, being a bit quirky, but you have to have a track record. You have to have something to bring to the table.
Yes, of course.
Yeah.
Sounds amazing.
Amazing.
Is there anything else you need to think about when talking about, for example, if you're a founder and taking venture capital, what should you think of then? What changes in the company?
Yeah, first thing I can say is that when you approach VC, don't be lazy, because they sometimes find that that's the case. Make sure you read up on them and know who they are, both the partners and the VC firm. What have they done? What are their interests? Because, they raise funds themselves, so they know what works and what doesn't. So don't be really, really ready, both with your own material and knowing who you are talking to. And another thing is, if you're approached by several VCs and they're attractive, look at their track record, but also look at what specific partner or investment manager would be involved would sit on your board. So cherry pick a bit if you can. That's one.
And of what I heard, where you talked about the angel investment in, when VC companies come in, I mean, a lot of things changes in the company.
Yeah.
You might already have some investors that are like owning a small stake in the company. So, I mean, it seems like a very big step to take as a founder to bring on the VCs.
It does.
Bring on the big guys.
It turns the heat up.
Yes.
It really does. And as an angel investor, you should expect to only be a minority investor, not having anything to say, really. So it really changes the dynamics and the power. But the VC will want to promote that the founder has a sufficient equity stake. So they do support the founders still having a strong position in the company. So they're incentivized to really build the company. Typically, a VC would take 20-25% if they were talking about the whole round. And then they often participate in follow-on investment.
Well, great explained.
Thank you.
So if you want to be a part of the VC investors in the future, and maybe you're a founder and thinking about bringing on some VC money, then you have this masterclass, and this one was the basic one.
Yeah.
We talked about what a VC fund is and how it works.
Perfect.
That sounds perfect.
Yeah.
So I really hope that this is a good information for you. And do not forget to like and subscribe our channel. And as we said before, this is featured by the LE Fitness, and we are very happy to work with them.
Perfect.
Thank you for today.
Thank you. Bye-bye.
We're here today to talk about a very cool word, dry powder.
Indeed.
So stay tuned, because in this episode you will learn exactly what it is and how you can know the market and know what's happening in the startup world.
How it impacts you when you're trying to fundraise, really.
Yes.
Yeah.
This is going to be so interesting. So do not press the stop button here. Let's start.
Yeah.
This episode, we are powered by the LE Fitness, which we are very, very happy about.
Yeah, amazing. Well, dry powder, that is the capital, the money that a venture capital firm has committed and not yet invested into any startups. So if I raise a venture capital fund of 200 million and I've used 50 million and invested in brilliant startups that I have found, then I have 150 million in dry powder. And the chance of you getting funded and what terms. Because the amount of dry powder on the market will have a direct implication for how easy it is for the startups to access that capital.
Yeah.
Yeah. And that means I will be out deal sourcing. And if you look broadly at the general market, if there is a lot of VCs sitting on dry powder, there's a lot of dry powder. That means it will be easier for you startups to access capital. There is more capital to be deployed, and there can be more competition about the good deals. So if you're a great startup, you might get approached by many VCs because they all have dry powder, all want to get in on that deal. That means you can perhaps retain more control. You might be able to raise your valuation and get other preferable terms and conditions.
Okay, so what I understand now is the dry powder is the money or the things that are left after.
Still, that they can still deploy into startups.
Oh,
still
okay.
Invest.
But why dry powder?
Yeah, that is historical.
Interesting.
Yeah.
Yeah.
Because when you were shooting your cannons,
you
could only use dry powder to fire. And if the powder was wet, it was not usable. It was worthless. So dry powder, you can shoot. You can do your investments. You have your guns ready.
You have your guns ready. That's so cool. I understand it. I understand totally.
Yeah. So it's ready to fire, do the investment. And we talked about on the first episode that any VC fund has a limited lifespan. So in relation to a fund, it can be a sign of power if you have a lot of dry powder. You raise the fund, you close it fast, you have a lot of dry powder, you're out looking brilliant. but the clock is ticking. Your investors want you to deploy that money and give you the return of investment. So it can be stressful for a fund if it has a lot of dry powder and it's coming closer and closer to the end, which means that it might deploy less favorable terms or not be too opportunistic, so forth. So having a lot of dry powder, power, but it can also be an issue. And it can also tell that you might not be the most attractive VC, so you might not get in on the best deal, so you might have a tougher time deploying. You might have gotten a bad rap because you were involved with a failure, or one of your partners is known for not treating the founders of the companies nicely. So it's kind of a sensitive topic.
Sensitive things. You need to be on top. Yeah,
indeed.
But what happens if you have like a lot of dry powder left and the clock has been ticking a bit too long? What happens then? And you need to close the fund.
Well, worst case, you need to renegotiate with the investors, or they only get their capital back, or hardly that. So, I mean, if you close the fund as a failure, it will be harder for you to raise a new fund, of course. It can also be that you have a specific possibility to prolong the lifespan of the fund for a couple of more years, so you have some more time. And you can negotiate about a rollover, putting it into another fund. There are solutions, but they are not preferable, because then it takes more time to get the return of the investment, if at all. So you can. And if you look at the other way around, what happens to the markets if there's a little dry powder, not a lot? Well, that means it's harder to gain access to the capital. It can also indicate that the investors have less faith in the startup ecosystem, in the markets in general. They're clinging on to their monies. So then the climate will be rougher, and you might need to accept even less favorable terms in order to get the VC to pick you.
Okay, but are the VC funds open about that they have a lot of dry powder?
No.
They are not?
Good question. No. So it all depends on what you know. Sometimes they toot their horns. When they close the fund, I closed a 5 million fund in half a year. Wow, I'm brilliant. Well, then if you look at that fund 2 years later and you look at their homepage, you should expect a lot of logos on it, and you should be able to, through different official sources, be able to trace if they have deployed that capital or not. So typically you can find out.
You can find out,
yeah,
but they're not open. Okay.
And it's also important to have dry powder so you can do follow-on investments. As a startup, if you're getting approached, it might be more attractive to choose the VC that can promise you that if you reach your benchmarks and your KPIs, they do have dry powder put aside that they can utilize for you to support you along the way.
Wow, so the dry powder is the guns are loaded.
The guns
We're ready
are
to
loaded.
invest.
Exactly.
Wow. It's so cool terms and lingo in the business world.
Agree.
So I hope really this is information that you can use and understand also what dry powder is when people talk about it. Because, I mean, a lot of things in the business world is knowing the words.
Indeed.
It's power.
It's fun.
It's really fun. I learn so much how sitting with Kat every week.
Thank you.
So we see you next time. And don't forget to like and subscribe our channel for more business law to help you gain knowledge and also good strategies to keep your business to the best heights ever.
You are great.
You are great. Keep on rocking out there.
Bye-bye.
Bye. If you do not want to stand there and watch other people get rich, you must learn about venture capital. This is for you who wants to work in venture capital, maybe seeking an investment or want to become a brilliant investor. In this masterclass about venture capital, we're going to present everything you need to know about venture capital, and maybe you learn something that could depend on your financial future and you can become rich. So, welcome to the Venture Capital Masterclass. And have you ever wondered how the money are managed in a venture capital fund? Today, we're going to talk about two key terms when it comes to venture capital, which is the committed capital and capital call.
Yep.
And as always, we have Kat here, the business lawyer, to explain everything to us. And we are also powered by the LE Fitness today. we are very happy about that.
Indeed.
So let's start. The 2 key terms.
Okay, so let's start with capital, committed capital.
Yes.
Yeah. So when you close, because we talked about that in the first episode, that a fund, a VC fund, does not live forever. It has a lifespan of 5 or 10 or 12 years, somewhere in between. So when you close a fund, that means that the VC partners has fundraised and raised the size of the fund. But when you close the fund, let's say you, Ida, you have Stellar Fund number 3 that you're fundraising. Yeah. So you close it with a committed capital of 500 million US dollars. That does not mean that your fund has 500 million US dollars in the bank.
Okay.
Committed capital only means that you can call on it from your investors, the LPs.
Oh.
So it's a legally binding. If I'm one of your investors, I have committed 100 million of those 500 million. Then that is committed. That's a promise that when you call upon it, I will send it to you within perhaps 10 business days or even 15 sometimes. But it's a short period I have. So it's very heavy penalties if I would not send the money. So the money always comes through, I would say.
That was my question. So you're committed to this money?
Yeah, absolutely. Okay. The money comes through. So when will you call on it? You will call on it, do a drawdown, it's also called, when you have found that startup worth investing in, or when you want your management fee.
Which is?
A yearly, typically 2% fee. The other one is the carry, and we'll have a specific episode about the waterfall and the carry where we'll walk you through it in detail. But for now, you can have heard the 2-20 model, where 2% yearly management fee and 20% will only be a profit sharing if the fund goes well.
Okay, but these 2% the investors are paying?
Yeah.
Okay.
Yes. And of course, if you're a challenger, this was your Stellar Fund number 1, I've never heard about you and I'm a bit grumpy, then you might say, well, I won't charge any management fee. That's my competitive edge. I will only charge the profit, or I will only charge 0.5% management fee. Or it will taper off. It will be 2% first 2 years when I have a lot of costs and due diligence looking at the companies, and then it will taper off. But typically it's 2% management. But going back to the terms of today's episode, committed capital, the promise. And capital calls, that's when you call on the money. And then we have deployed capital. That is the capital that you have called on and that is invested, put to work, or used
like
for the
already
management.
used. Okay.
Yeah, exactly. And in the Masterclass number 2, we talked about dry powder. So if we have 500 in committed capital, and you call on 200 and use those for startups, then we have 300 in committed capital, not yet called on, not yet deployed, put to work. That means that we have a dry powder of 300. So for any of you founders looking for a VC investment, it's key for you to understand how big is the fund, how much capital do they have committed, and how much is already deployed, which means it's not available for you. And also for you breaking into venture capitalism, you will want to understand this because this is also strategic. Because if you want to do follow-on investments, do you have committed capital, not yet used, etc.
So that's it. That's it. It's really good to know because, I mean, these words, you hear about them all the time. And now you know. So if you want to get into venture capital, you need these 2 key terms.
And when we get back to the waterfall, we will also tell you about recycling of already committed capital. But that's for another. We're going deeper and deeper.
We're going down. It's so fun to share this.
Yeah.
So if you want to get into venture capital, you now have 2 more tools in your toolbox. And we're so happy to share this with you.
Fantastic.
So stay tuned and follow up for the next venture capital masterclasses. watch a lot of people get rich. Well, this could be an opportunity as well if you learn about venture capital. And that's why we have this masterclass. If you want seeking investors or maybe want to make businesses in venture capital or maybe just become a brilliant investor, this masterclass is definitely for you. We are powered by the LE Fitness. Thank you so much for hanging out here today. But in this episode, we're going to show you how the decisions are being made inside the venture capital. And that could be good for you if you want to get rich and learn how the venture capital works. Stick around because at the end of this episode, you know exactly what they are talking about. And as always, we have Kat, our business lawyer, here with us. You're going to explain it.
Hello.
Hello. How does the decision go around inside the venture capital fund?
Yeah, so we're going to give you some key insights that you can think about, regardless of whether you want to work in venture capital or if you're seeking a venture capital investment, because it's very different from if you have had negotiations with angels priorly. Because angels, they invest their own money, right?
Yeah.
A VC firm will gather other people's money and they will invest some themselves because the LPs, the investors, will demand that typically. And then they pool that money and make the investment. But what we're going to talk about here that differentiates a lot between a typical angel investor and a VC will be the decision process. And of course, every VC firm has its right to do whatever they want. So this is the typical structure, of course.
So let's start. And if you want to have more knowledge about venture capital, do not forget to like, subscribe, and share this channel to your network.
Indeed.
So let's start.
Well, we typically talk about a deal funnel. And there was a brilliant, I forgot his name, so we'll drop the link down below, a professor from Stanford who looked at the mid-sized VC firms in the US and said that one of 100 will turn out to be a yes of all of the companies they look at. So if they look at 400 a year, 4 would be invested in. So I mean, it's narrow who even gets that far. But we'll describe it in 4 steps. So step number 1 will be the deal sourcing. And that can pretty much be anybody in the deal team at a venture capital firm, anybody with sufficient contacts in the firm really or employed in the firm to pull that and present it for the deal team. So number 1 will be somebody in the deal team, investment manager, it can be a partner, it can be an associate, somebody, looking at the company and getting excited. Step number 1, the deal sourcing, you need somebody within the VC firm getting excited. Then they will often take it to the deal team. And they need to get somebody, again, within the firm. Step number 2, it can be the deal team, the director or the partner of that deal team, sufficiently excited as well. So they keep evaluating and digging deeper and deeper into that startup. And if you get to that second step, step number 2, where the deal team, the partner, the one with sufficient mandate, is excited, and you have a clear outlining what the deal would look like, then that director, partner, will take it to the investment committee. And I don't know if you ever heard that you often say that never call a VC partner on a Monday because that's when they have their investment committee meeting. I don't know if everybody has that, but that's like the standard case.
Now you know.
Yeah. So what's good to know about this third step about bringing it up in an investment committee, it is that when you look at Dragon's Den, for example, right, or Shark Tank, you will be pitching your own startup to the investor. What I'm talking about is you not even being in the room. So you need to empower that partner or that investment manager who's going to present your case for the investment committee. And that's a huge difference if you're not even in the room when they discuss the yes or no, right? So that's a big learning. And if you're breaking into venture capital and want to work with it, you need to understand how much politics goes into competing for that yes in the investment committee. Because if everyone's looking at hundreds of deals every year, but only a few get selected, you'll be in trouble if you have not presented any deals that go to an investment for a couple of years. Then you might be called into question. And also, if you do present a deal and it gets to a yes, and it doesn't work out in the end, you will be held accountable. So you need to understand this dynamic that if you're going to champion a startup, an investment case, you need to know that it's important to have some successes, but also that they do materialize in the end, at least in the long term. So that's number 3. You get to the investment committee, and at that point, like I said, you want the clarity enough. What's the ticket size? What valuation are we talking about? And if you get a yes, that typically will mean that you do at least the confirmatory due diligence, and you dig deep and get to the paperwork. And then you have step number 4, and that will be pulling the trigger, using the gunpowder, saying the yes. And that will, of course, mean that you need to check, did everything work out? If the investment committee had a yes, no, or maybe, perhaps there was something they wanted to dig deeper in, the IP, the competitive, or they have questions about the team, the founders. So you need clarity, and you might need to bring that up before you get that final yes. So typically 4 steps. But it can also be that you're talking to a VC, let's say that Stellar Fund, with your 5, when you use that as an ongoing example. You, Ida, founded Stellar Fund Management with Stellar Fund number 1, 2, and 3. And you are the senior partner, so you already have a mandate. Perhaps you can use up to 50 million on your own. You utilize the deal team and you say yes and you pull the trigger. That can be. But typically, you will want the checks and balances, and you will want to be challenged internally. And then, as I said, you might bring the founder in to do a presentation, but then they will leave the room. And you will challenge it, and you will want to either advocate saying yes, and somebody else might say no. And it might even be politics. They might want to say no because they feel that you already pushed 3 deals through, and they have not gotten one of their cases through. So there's a complex dynamic to think about.
That you must know about as a startup founder.
Exactly. So it helps either if you want to work with venture capital, understanding how much relationships, how much communication, how much it is positioning the case, and also be held accountable for the case going forward. And of course, in venture capital, home runs counts, strikeouts don't, which means that it's okay that you fail some. That's not it. But know that you will be held accountable. And understand how much relationship building. And as a founder pitching, understand how much it's about empowering the deal team or the investment manager that you're communicating with so that they can go to the rest of the venture capital firm and pitch your case.
So that's why it's so important for startups to always be up and networking, pitching, so you just meet the right person.
And understand the complexity, because maybe if I'm talking to you and you're just an investment manager at Stellar Funds, you might be super interested about this hot new tech aspect. But if I try to understand Stellar Fund Management as a whole, and I look at your track record and the other cases you have invested in, it might be a lot of sustainability edges. Then I might realize that, okay, this is your baby, the tech part. But perhaps when you go to the investment committee, you will get hammered on the sustainability aspect. So I need to understand the interest of the collective, not only what gets you fired up.
Okay. So if I understand it right, I mean, when you do the investments in the VC fund, does everybody need to be on board with the idea they are investing in? Or
that depends on how the investment committee, I mean, it can be a majority decision.
Okay.
It can be that only the partners get to vote. But do know that you will be challenged, in particular if you are an investment manager or you're dealing not with a partner but an investment manager.
Thank you.
Thank you.
That's so valuable knowledge. And now you know how the decision process are being made inside the venture capital funds. Thanks for today, and do not forget to like, subscribe, and share our channel to your network, because this is crucial and really important knowledge that we're sharing. And remember, it's knowledge sharing and not legal advice.
Indeed.
Thanks for today, and rock on with your businesses.
Don't forget our sponsors.
We are powered by the LE Fitness. Thank you so much for hanging out with us here today. If you don't want to stand there and watch other people get rich, this is for you. Then you need to know about venture capital. Whether you want to seek investment, work in venture capital, or want to become a brilliant investor, stay tuned. This is for you, and it can really secure your future in the financial way. So today we're going to talk about 5 different exit strategies that you can use when exit a venture capital. It's going to be so excited, and this is for you that wants to know more about this and make money. Especially if you're a startup and you're bringing on venture capital money, it's really good knowledge for you. And also, we are powered by the LE Fitness today, which we are very happy about. Stay tuned. Let's go.
Let's go.
So let's start.
Top 5 exits that a VC firm will do, which means that the startup that a VC firm has invested in will do. And number 1 will be
the IPO.
The IPO. That is getting the shares noted at the public market, publicly traded. And that's huge, typically seen as the one exit that gives the best return of investment. And it's very fancy. It's really like you made it. It's really prestigious to get to ring that bell at Nasdaq New York or wherever.
So then where's the big money is.
Yeah. But of course, depending on what exchange you're going for, the qualifications will be higher or much, much lower. So not all IPOs are created equal. But that's the top exit, typically, that the VC firm wants to see your startup go through. They want it to happen. But also know, and this is really good for you to know, because few talk about this, this is not really an exit for the venture capital firm. This is a pre-exit moment. Because the venture capital, when you go to the IPO, when you get noted at the stock market, they're not selling their shares. They will be subject to a lock-in that can be 6 months, 12 months, or even 24. So this is a pre-exit happening. And then once the shares of the startup is traded at the stock market, then they can divest, as it's called, sell their shares.
Okay.
That's number 1.
Number 1. We're heading to number 2, which is the acquisitions M&A.
Yeah. So you heard about M&A, mergers and acquisitions. And the big part in that sentence will be the acquisition. That's when you get bought by another company, typically a strategic buyer, somebody who's in the same industry. Can also be a private equity firm or somebody else.
Okay.
But for instance, if you're a tech startup and Google comes knocking at your door and you sell to Google, then that was an acquisition. And that's also a really nice exit to have. It doesn't have to be, it can be a hardship exit, but typically it can be sweet.
That was number 2, the acquisition.
Yep.
And number 3 is secondary sale.
Secondary sale, that will mean that the VC firm only, if you have a startup and I'm the VC firm and I hold 25% in your startup, then you will not make a wholesale all the shares. Instead, the VC firm only sells its portion to somebody else. And that can be in a subsequent funding round when a new investor with new blood comes in, believing in the company, and they want a bigger stake, then I might be able to sell my portion, often at a discount, unfortunately. But if I don't really believe in the startup anymore, or I don't have the dry powder to continue to follow-on investment, or for some other reason, perhaps I'm getting close to shutting my fund down, so I just want the liquidity, I might be willing to sell early because I don't really see the future any potential for that great exit or return investment on my stake. It might be a down round also. So secondary sale where the VC sells their portion only.
Okay, that was number 3. The number 4, which is the MBA.
The management buyout.
Sounds cool.
Yeah, it is. It's really cool, and we're happy to have a separate episode. Let us know in the comments if you want us to dig down in how the MBO works, because it's super exciting. But to keep it short and simple, what you need to know, then it's the management, the current management of the startup says that, you know what, we'll buy you out. And the trouble with it is, of course, that the management then needs to find funding. So they're private persons running the company. They need to find other backers in order for this to go through. And this can often be the case if you see that the company is going okay. It has the revenue. It's perhaps making black figures even. But it's not that exit case that I, as the venture capital firm, was going for. So then this restructuring can happen. The MBO, the management buys out the current VC. So I get liquidity, I get to say thank you and bye. I have my cash back. I can send it back to my LPs, my investors. And then you have some other financing, some leverage finance typically. And continue on the journey.
That was number 4, the MBO. Number 5 then, it's the liquidation.
Liquidation or shutdown. It did not go as planned at all. No. So we're talking about bankruptcy. We're talking about an orderly shutdown. Sometimes perhaps you can sell off some IP or license something out, but in a shutdown, the venture capital firm will typically see no money at all.
Okay.
Because if there is any money left from selling the IP or something, there will typically be debt that needs to be paid, prioritized, anything from salary to bank loans that will go before us shareholders. So number 5, the exit, that is a shutdown or liquidity or just liquidating the company, bankruptcy.
It sounds like a worst case scenario.
So we went from
the best.
Number 1, IPO. Number 2, acquisition, part of an M&A deal. Number 3, we talk secondary sale, selling your portion to somebody else. Number 4, MBO, management buyout. And number 5 was the shutdown. There it is.
We don't want that to happen. We don't want that to happen.
No.
But now you know the top exit ways when you're exiting a VC.
And we have a sponsor.
We have a sponsor. It's the LE Fitness, which we are very happy to share. It's a gym chain.
Indeed. Very happy to be here. And key knowledge for your success, key?
Always keep educating yourself. And how do you do that? Yes, you're going to follow us, you're going to like, and you're going to subscribe and share our channel to your network. And comment.
If you want us to dig deep, you need more, you thought this was too high level, let us know. Drop a comment. We're there for you.
Yes. We'd like to hear from you. That was all for today. Now go rock on your venture capital. If you do not want to watch other people get rich and you being left behind, this is for you. Welcome to our masterclass about venture capital. Whether you are seeking an investment, maybe you want to work in venture capital, or just to become a brilliant investor, stay tuned. Today, we're going to talk about waterfall distribution, which is key if you want to know how the money is split and flowing within the venture capital. As always, we have our fantastic business lawyer, Kat, here to explain it.
Hello.
And we're going to give you concrete examples and very deep dive in a calculation. And you're going to get more information than you usually are getting in this episode.
Yeah, we're going to help you out.
We're going to really help you out. So let's start. The waterfall distribution, to begin with, what is it?
Good question.
Yes.
The waterfall distribution, that is when you invest in the VC fund, it in its turn invests in startups, then it exits those startups, get money back. But then when you have that profit, that result, what happens? Well, you need to distribute that money, right?
To the investors and
yourself.
Yeah.
Don't forget yourself.
I'm not.
So that's the waterfall. And that is typically or always made in 4 tiers, which means that the water will only trickle down from number 1 to number 2 if there is money left to go to step number 2, and then from number 2 to number 3 if there is money left to go to number 3, and then from number 3 to number 4 if there is money left. So if you only have money for step number 1 in the waterfall, the other things won't happen. And number 1, we'll go through them quickly, and then we'll get back with a concrete example that will help you.
Yeah.
And like you said, we will in this example explain some variables that you typically do not hear about that is key to understanding the waterfall and the dynamics of how the venture capital firm will work with its committed capital and with its startup seeking quick exits, etc. So number 1 will be the return of capital. That means that the LPs, the investors, will need to get their monies back before any profit can be shared. Then number 2 will be the preferred return. That will be a hurdle rate where the LPs, the investors, get typically 8% return of capital before the venture capital manager gets to participate in the profit split. Then number 3 will be a catch-up for the venture capital manager, the GP. And that is because if all goes well and you come to the full carry mode, as it's called, then the manager is entitled to 20%, typically again, can of course vary, 20% of the profit. That means that they want to catch up that hurdle rate portion so that they get 20% of that hurdle rate amount plus their catch-up amount. And then when they have catched up, we go to number 4, which is full carry mode, which is a 80-20 split, where the investors get 80% and the manager, the GP, gets 20%. And we'll go through this. It will become much clearer when we deep dive into an example now. And we're going to use Ida.
Yes.
So Ida, you are the founder of Stellar Fund Management. You successfully raised 2 previous funds, and now you're on fund number 3. And you have LPs that committed $500 million in this fund, right?
Yep.
So that is the assets under management in total, so to speak. We'll get back to that. And then after 8 years, when you close down the fund, you get a return of investment of $1.5 billion. So a 3x return. Yeah.
That's really good.
That's really good.
I'm satisfied.
Yeah. So you deployed 500 and you get 1,500,000 back. And now we're going to go through the waterfall together. So what was number 1? You remember?
Yep, that was the return on investment.
And how much capital did you have in investment?
500 million.
Yes. So step number 1, 500 of those, we'll call 1,500 now, just to make it simple, goes back to the investors. Step number 1, right? And then we check, do we still have capital enough so that the waterfall can go to step number 2? Yes.
Yes, it's 1,000 left.
Yeah. Let's say that instead, when you close the fund, you had 490 million back. Then we would take 490, the fund result, minus 500, the committed capital, and we would have a negative result of 10. That means that the investors, the LP, will get 490, everything back, and they would have made a loss of 10 million. And you, as the manager, the GP, will get 0, right?
Yes.
So the waterfall will stop. But in our case, we're happy.
Yes.
So we go to number 2, yeah? And that is the preferred return. Now the LPs want 8% compounded for the, let's say we had a 5-year fund, lifespan of 5 years. So they want 8% compounded over those 5 years back before you can get anything. So then we will simply do the calculation. 500 million US dollars times 1.08 for 8% for 5 years. And then we'll take that less the amount already received in step number 1, the 5 million. And that will leave us with approximately 235 million. So 235 million US dollars of that billion will, in step number 2, go back to the limited partners, the investors, which is not you, the GP.
No.
And for now, we're not talking about if the GP also has invested in the fund. So you might also be an LP, like a small portion, because typically the LPs want the GP to also invest.
Okay.
But then you are covered because you're part of the LP group. So in the second stage of the waterfall, the LP gets 235 million and the GP, the manager, still gets 0. Now we check, is there anything left for step number 3 in the waterfall, or do we stop here? Well,
We have left.
we have left. We take 1,500 million US dollars, the fund result, minus 500 US dollars, return of capital, minus 235 million US dollars, the preferred return, and that means we have $765 million left to distribute, right? So we go to step number 3.
Which is?
That is the catch-up.
Okay.
And we touched upon the carried interest being you, the fund manager, being entitled to 20% of all profits of the fund, right? That means that you are entitled to also have 20% of the hurdle rate portion, right? So it should be of all profits. So that's a bit complex. So in this catch-up phase, the distribution will disproportionately go to you as the GP, because you're going to catch up, because I already had some, right? So in this example, we're going to assume that you get 100% during the catch-up. But many LPs will demand that they get a portion of every extra dollar that is distributed from the fund. So instead of 100% going to the GP in the catch-up phase, it can be that 80% goes to the GP and 20% go to the LP, or 50-50. And what happens then? Well, the catch-up takes longer. Because for every extra dollar, you don't catch up directly. I also get some money back. So that means that you as the manager need to have reached a bigger and better result in total in order for you to get the full 20% of all profits. So let's jump back to Stellar Fund number 3 with the total profits was 1 billion, right? Yeah. And the preferred return already provided to the LPs was 235. And assuming a full catch-up, so 100% going to you, since the LPs have received 235 million, the GP should receive an amount ensuring that said amount is 20% of 235 million plus that amount. This means that the GP should receive 235 million divided by 0.8, with the result reduced by 235. That's equaling 58.75 million. And let's test this. Is 235 million 80% of 235 million plus 58 million.75? And 235 plus 58 million.75 times 0.8 equals 293.75 million US dollars.
That's
so
correct.
that is correct. Thank you, Ida. And just to help you out and illustrate this further so you really understand the catch-up, because typically I hear people just run over this in the explanation, so people don't really understand it. Let's look at an example. If Stellar Fund had a total profit after a return of capital of 250 million only, well, in this case, the LP would still get that hurdle rate, 235 million in the 8% return. But then the GP would only receive 250 million minus 235 million, equaling 15 million. So you would never reach a full catch-up, right? You would only have gotten 6% of the total profits. So that's why we have this in different steps in the waterfall, because it will kind of be your problem if we do not reach the full catch-up, not my problem as the LP. So I have a better deal in that sense, since it's my money. Number 4, the full carry mode. In this step, we have the 80-20 split. So you will get full carry, the carried interest, the one that you are getting rich on. Because me as an LP, I'm typically an institutional investor or some other big corp perhaps. But you, as the fund manager, will most likely be one of a few team that gets huge amounts in your pocket. So waterfall step number 4. We had $1,000 million US dollars, we can say, minus 293.75 million US dollars. So we have, for the final step, 706.25 million US dollars left for the full carry mode. So we will split it simply. We will take 706.25 times 0.8, which means that there is 565 million to the LPs, and we will take 706.25 times 0.2, equaling 141.25 to you, the GP, in carried interest. And now let's just see the final result. The final result, the LP got, on top of return on capital, 235 plus 565, that's 800 million US dollars. And the GP got 58.75 plus 141.25, equaling 200 million US dollars. And if we're wondering, oh gosh, did we do this catch up correctly or not? Well, if we're wondering that, then we can simply check. The profit of the fund was
1 billion.
Yeah. And what's 80% of 1 billion?
It's 800 million.
Yeah, and that's exactly what we got. And what's 20% of 1 million?
It's 200 million.
And that's what you get in carry, right?
Yes.
So we made it.
Really good. I mean, we made it all the 4 steps.
Yeah.
So it makes it profitable for everyone.
Yes. And we're going to share more insights, more deep dive for you, so you really know.
That's so good.
Yeah. One thing to know is that this 80-20 split, it can be up to a certain level where the LPs say that, well, if you reach that level, after that, perhaps, let's say the fund result is 2 billion. After that, we will go for a 70-30 split instead, or even a 50-50 split. So if the results are crazy good, you might even get more carry because you can layer it. So you can have how many steps you want in the waterfall, really.
Depending on if I did a good job or not.
Exactly. So if the results are, because I mean, then I might be super satisfied already with the catch-up and the hurdle rate and the profit split at step number 4. So if we reach even further, because the results are so big, I'm happy to give you more because you deserve it.
Yeah. Wow.
And one more thing, when we talked about that hurdle rate and the committed capital, we said that we took the 500 million times 8% hurdle rate, for 5 years, a really important nuance for you to know is that the preferred return, that 8%, is only calculated on the capital that you have actually called upon, actually draw down and actually have under management.
Which means it's not the dry powder.
No, exactly. Which means that you as the VC, as the general partner of Stellar Fund number 3, will want to keep that period as short as ever possible. Because that will make it, you will better get quicker to the full carry mode, right?
Yeah.
Because it's less of a preferred return hurdle for you to get before you get to the catch-up and the full carry. And we can take an example. For example, imagine that instead of having all of the capital draw down on day number 1, which is very unrealistic, but that's just to make it simple, let's instead assume that the first 200 million is deployed in year 1 and exit is made after 3 years. And the remaining 300 million are deployed year 3 and exit is made after 2 years. And that's very plausible because it takes time to deal source, make the exit, etc. Then the preferred return in this case will be 200 million times 1.08 for 3 years minus 200 million, the return on capital, which is 129.9 million, and 300 million times 1.08 for 2 years minus 200 million. That's 41.6 million, which in total is 175.5 million. So compared to our first example, number 1, this means that there is a difference of more than $65 million for the hurdle rate. So again, why does this matter? Well, the GP, you will not get any profit sharing until all the preferred return has been paid out. So that's why you as the GP will typically aim to hold the startups and make an exit as quickly as possible. And that's good for any of you startups out there to know when we say that when you have VC money, the clock is ticking. It really is ticking. Because it's money not entering into their pockets, perhaps. If you get to full carry mode, it will still be the 80-20 split, so you're okay. But getting there.
Wow, this is such a great example. I'm blown away.
And if you want us to do a deep dive in either the carry, and also we're going to show you in the next episode how it's typically split. The carry is actually split between the partners in the GP, but also with the preferred return. And we're happy to do a deep dive to show you how it works with different portions in the committed capital. And also we can show you an example, a calculation example, where the catch-up is not full catch-up, 100%, like in this case.
Yeah, really good.
Where it's instead 80-20 or 50-50. So just drop a comment below if you want that. We'll help you.
And I do have a question, because this is like a mechanism to split the money. Is this standard procedure? You always do like this?
Yeah.
Typically?
Yeah, this is very standard procedure. What can differ is the numbers. I mean, the preferred return can be 5, it can be 12. The carry could be, I mean, if you're new in the game, you might say, I'll start with 10% carry until I reached a return of 200 million, because my fund is 50 million. And then after 200 million, I will take 20% carry. And then after 400 million, I will take 50% carry or something else. So the numbers can differ, but the structure, the waterfall structure with number 1, return on capital, number 2, a preferred return, number 3, a catch-up, and number 4, full carry mode, full profit split. That is very, very standard. And typically, it is 80-20, the split.
Yeah, and I mean, it totally makes sense when you're describing it. So it sounds like a really good mechanism to have.
Because we want The same thing, right?
Yeah.
But also, since it's my money, I want money back first.
Exactly.
And like we talk about, typically, the LPs will also require the GP to be an LP. So typically, they will say that I want 1 or 2% of the committed capital to come from your pocket. Because I do not want you to risk my money just to reach that high carry. Because, I mean, it doesn't matter. You have the management fee, so why not go crazy? I want you to kind of not sleep too well at night if the fund goes bad.
So it's a bit of a hook.
Yeah, indeed.
But is it common that the GP also acts as an LP?
Yeah, as I just said,
yeah.
it's typically a requirement.
Typically?
Yeah.
Okay.
Because we want you to have skin in the game.
That's really good.
Yeah. So if it's your first fund, you will typically need to have a loan, finance it in some way.
Good.
Yeah.
Well, thank you for explaining it so well. And now when you watch this, you know about the waterfall distribution.
And just drop any questions down below. We can make it even more complex. We can have an Excel spreadsheet if you want.
Yes, it's really interesting. Now you know about it, and really when people are talking about the waterfall distribution, you know exactly what they are talking about.
And our sponsor.
We have a sponsor. And this episode is powered by LE Fitness. Thank you for today, and as Kat said, if you have any questions, just drop them down below. And share this channel with your network, like, subscribe, because we're going to keep doing this. If you don't want to see other people get rich and you being left behind, this one is for you. Whether you're seeking investments, maybe you want to work in venture capital, or just want to become a brilliant investor, this masterclass is definitely something that you can have use for. And today, this episode is powered by LE Fitness. Do not forget that this is not legal advice, it's knowledge sharing. It's very important to have in mind. We have our business lawyer here to explain everything we need to know, and we're happy that you're here with us. Today, we're going to talk about something sexy as carried interest. The word you hear about all the time, but what is it exactly, and how does it work, and why does it exist? Kat is here, our business lawyer, to explain everything to us. Let's start with the juicy details.
The juicy. Well, it is. It's the carry. It's the get rich.
We love that.
Venture capital has partners, managers, the fund managers, the ones that starts the fund, that manages the capital, makes the investment decisions, and that once the fund is profitable, if it is profitable, gets a return of that profit. So they have LPs, investors, and we have the GP. And we use the example, Stellar Fund number 3, which you, Ida, had founded. So you're part of the Stellar Fund Management. Fund number 1, Fund number 2, and now Fund number 3.
Yeah.
Yeah. So you will be entitled to carried interest on this fund if it goes well. So if I, as an LP, an investor, get my return of capital and preferred return, then you will be entitled to 20% of all proceeds from that fund. And now we're talking money.
We're talking money now.
Yeah. And if you heard about the 220, it will be 2% in management fee, which will be yearly. So in our example, we had a fund which had committed capital of 500. So already the management fee of 2% of 500, that's 10 million yearly for salaries, deal costs, offices, anything. That's quite okay.
Yeah.
So you will already have a good salary baseline. And of course, if you're a new challenger fund, you might not even charge a management fee. It can be higher. It can taper off, so it's bigger in the first years and lower the last years because you don't have the same costs. Because typically, the manager will have the investment costs, the due diligence when you invest in a startup. But when the startup makes an IPO or other exits, the costs will be on the startup, not directly on you as a VC. So it can vary, but the 2 and 20 model is good to have heard because that's the typical. And now we're talking about the carry, the 20%. And in the last episode, we showed the waterfall with 4 steps, where step number 4 was full carry mode. Number 1, return of capital. Number 2, preferred and the hurdle rate, 8% to the LPs. Number 3, the catch-up, so we make sure that you do get that 20% of all of the proceeds on top of the committed capital. And then we have the full carry, 20%, step number 4. So in that example, we ended up with 200 million in carried interest.
Which is a lot.
Yeah. So now we're going to show how that typically is divided. And before we give you those insights, we're going to mention that the big kind of discussion or the sensitivity around carried will be tax.
Oh.
Should it be taxed as income on top of your salary or as capital gains? And that's a huge difference. So pretty much all jurisdictions, this is a push and pull. And with the US, you might have heard of the carry loophole. But just mentioning it. Now let's go back to the 200 million that you have gotten in carry. So in order to know what does that mean, what happens with that, we will need to look at the VC, the management structure. So let's say that you, Ida, you are the face of Stellar Funds. You're the star, you're the core founder. And then you have 2 other senior partners on the fund, because typically the fund has partners. And then you just brought on 2 junior partners as well. So the senior partners are Becca and Alex. And the junior partners are Kat and Anders. And then you also have a deal team of 5, C-level and deal team. So they also have an entitlement to some of the carry. Typically, you will take the right to carry and divide it into units that you will apply already when you decide this when you do not know the carry full out, typically. So you, Ida, you're entitled, you have 10 units in the Stellar Fund that you will portion out to everybody who's entitled to carry at all. So you're the super senior partner, so you're entitled to 3 units. And then we had Becca and Alex as senior partners. They're entitled to 2 units each. And then we have the junior partners who are Kat and Anders. They have a right to 1 unit each. And then the deal team and the C-level, they have a right to 1 unit in total, split amongst themselves. That means that we had 10 units in total. So if you have 3 units and we have a result of 200, we take 200 million, divide it into 10 to know what each unit represents. So 200 divided into 10 is?
20.
And you have 3 units. So then we take 20 times 3, and that is?
60.
Which means that you get the nimble sum of $60 million in carry.
I accept that.
That is why everybody wants in on VC.
Yeah.
And you carry less of a risk than a startup, because the startup only has 1 chance. You have all of the startups that the VC invest in as your chance. You have risk diversification compared. So you get 60 million from 1 fund. And remember, this is fund number 3. You fundraise ongoingly. That's why carried interest is so sexy.
Yeah.
And then we had Becky and Alex. They had 2 units each. So then we take 2 times 20. So they get
40 each.
40 million each. Also okay.
Yeah.
And then Kat and Anders had 1 unit each. So 1 times 20 is?
20 million.
As a junior partner, I will be very happy to get 20 million in carried interest, right? And then we had the deal team. There were 5 splitting 1 unit of 20. So then we take 20 divided by 5 and we get?
2.
4.
4.
You're mesmerized by all the million.
My 60 million.
Yeah, you stop there.
2 is nothing for me.
So they each get 4 million in carry. And then, again, this was just one of the funds. It's an ever-spinning wheel. And of course, if the fund does not reach full carry mode, if you do not make a profit, you get 0. So you need to perform. it's not for the faint-hearted. You need to really perform. And if you do not perform, you might not even get to fundraise for a new fund, because all the LPs will say, well, thank you. I hardly got my monies back. I might as well put them in a mutual fund or in the stock market. But this is the core of how carry works. That's why it's so disproportionate for you as the GP to get 20% of that capital that somebody else put in the fund. So it's good to be a VC partner.
Yeah, it is. And this is very good information for those who want to work in venture capital, which I believe many wants to do.
I wouldn't mind.
I wouldn't mind too. Thank you so much.
Thank you.
And this episode is sponsored by LA Fitness. This is really good knowledge that we're sharing here, and keep yourself educated. I mean, we used to say keep educating yourself.
It is key.
It is key. And how do you do that? Well, you like, subscribe, and share to our channel, and also drop comments. If there's anything you need to know, want to know, have questions about, don't hesitate. I mean, we're here for you.
No, absolutely. If anything's unclear or you want to deep dive, we really do want to share this knowledge at zero cost, because business law can be so exclusive, it can be so excluding, and we do not want that. That's why we're doing this.
Yes, and also if you have experiences, please share them, because I believe many people want to read about them.
Yeah.
Thank you. That's all for today on our Venture Capital Masterclass. Until next time. So if you're one of those who don't want to see other people get rich and you're being left behind, this Venture Masterclass is for you. If you're seeking investment, or maybe you want to work in venture capital, or maybe just want to be a brilliant investor, this masterclass is, signed up for you.
Perfect.
So in this masterclass, we're going through different examples and real life examples in what you need to know. We have Kat, our business lawyer, here today. And today we're going to talk about how things can vary in venture capital between the European and the US. So across the Atlantic, a lot of things can happen.
Yeah. And also, what's known as the European model can be used by a US VC fund, of course. And what's known as the US model can be used in Europe.
Yes, just to make it a bit more complex.
Yeah, but this is typically what you see in the US and typically what you see in Europe. That's why they're called the US versus the European model.
Well, so hang in here, because now we're going to discuss some really heavy stuff.
Yeah.
Well, bring it on.
Well, this goes back to the GP, the fund manager, and when and if you're entitled to carried interest. Which is, again, we have a separate episode about the waterfall and one about the carry. Carried interest, profit split, once the investors, the LP, get their investment and their return on capital and a hurdle rate. Then we have a catch-up and a full carry mode. And there is a difference when you get it, depending on the European versus the US model.
Okay.
And the European model is generally seen as more LP, more investor-friendly, because then you will calculate your right to carry on the fund as a whole, on the totality.
Okay.
Whereas the US model, ongoingly, you will calculate deal by deal, which means that a good deal means that you directly have a right to carry, even if I haven't seen full return on capital and full hurdle rate. And therefore, in the US model, and we will have a specific episode about clawbacks we're doing, so it's easy for you to find what you're looking for. But then we will often need to use a clawback in case, in the end, that fantastic initial deal does not cover bad deals that happen afterwards. So the fund result doesn't warrant you getting as much carry as you got in the beginning. So that's why it's good for you, because you get carry more faster, instantaneously upon a good deal. By the European model, you need to wait.
Okay.
So an example?
Yes, an example.
Okay, so back to our example.
Yeah.
The European waterfall model. The key features are that there will be full return of capital to the LPs. So money's back plus preferred return, commonly 8%, before any carried interest is paid to you as the GP. So it's a single fund-wide approach. The model will evaluate the entire fund's performance, not the deal by deal, as in the US model that we just talked about. So, example, we have a fund of 100 million US dollars, and then the LP investment of 90 million US dollars, and the fund return will be 150 million US dollars after 8 years. So in the waterfall, first the LPs receive their 90 million back, then they will receive the preferred return, which is 8% of those, which is approximately 25 million, which is 8% compounded over the fund lifespan, where you have the committed capital deployed. And then we have a remaining 35 million, which will be split in carried interest. You need 20% for you as the GP, which will be 7 million US dollars, and 80% to the LP, which is 28 million US dollars. So the advantage for the LP will be that they are fully repaid, which minimizes the risks. You do not need a clawback, etc. And the challenges for you as a GP is that it takes a long time for you to see any money. And when we look at the US waterfall model, that will instead be the deal by deal as we discussed, which is better for you as the GP, the fund manager. So let's again look at a fund size of 100 million US dollars. The LP investment of 90 million. And deal 1 was an investment of 10 million US dollars with an exit of 30 million US dollars. Then we look at the waterfall, and the LP, step number 1 in the waterfall, received 10 million return of investment capital. Then we will calculate the preferred return only on that capital, which in this case means that we're talking about 1 million in preferred return. And the remaining 19 million will be split so that the LPs will be distributed and get 15.2 million, and you as the GP will get the carry of 3.8 million directly upon that deal. And then on subsequent deals, the GP will receive carried interest on that deal by deal basis. So the advantage again is quite clear that in the deal by deal US basis, you get carry quicker. So it's more of a risk for me, the LP, the investor, compared to you. And the European model takes longer for you to get any carry. But then we have the clawback, which is the next episode.
Yes.
Because I will still, if you get too much carry in the US model, I will typically and most likely still want that back, but that comes with complexity. Trying to claw it back.
Yeah, which we're going to describe a bit more in the next episode.
Stay tuned.
Stay tuned. Is there anything else we need
I
to
think
think?
that's it, actually. Well, I can add that these are the general, and 10 years ago, I would say it's the US or the European model. But today, people can be engineering. It can be kind of a hybrid where you utilize some bits and pieces of each model. So be mindful. I mean, if you have a better solution or you can negotiate with the LPs in some way, shape or form, where and sometimes you utilize an escrow account so that you get a split quicker, but you still cannot utilize the monies too fast. You also need to take tax accountability in consideration and so forth. That's it.
Really good things to have in your business law toolbox.
In the toolbox.
Keep educating yourself. And how do you do that? Well, you are liking, subscribing, and sharing our channel, and also drop comments if there's anything you want to know.
Yeah.
Just do it. We're here for you and we want to share knowledge. And remember, this is not legal advice, it's knowledge sharing. And this episode is also powered by LA Fitness. Thank you so much for today in this Venture Capital Masterclass. Keep on rocking. If you do not want to see other people get rich and you being left behind, this Venture Capital Masterclass is for you. Whether you're seeking investments, or maybe you just want to work in venture capital, as many people want, or maybe you want to be a brilliant investor, we have a masterclass where we go through a lot of things that you need to know when entering the venture capital world.
Yeah.
And today we're going to talk about clawbacks. I mean, I think a lot of you heard about it, but how does it really work? And what is it? And what has to be triggered to use the clawback? That's why we have our business lawyer here, Kat, to explain everything we need to know about the clawback. It sounds a bit dramatic, the clawback.
It is a bit dramatic.
This is what I'm...
Yeah, a claw.
Taking something back.
That's right.
Okay.
Yeah. So, it's most prominent in the US waterfall model, which we talked about in the last episode, which is where you get a deal-by-deal calculation of the waterfall, which means that you can get carried interest. We talked about you being a GP for Stellar Fund, right, Ida? So, if you do a great deal, your first investment, you put in 100 million and you get 200 million back. Then, and I'm the LP, then I will calculate it deal by deal. Then I first get 100 back, because we only calculate on the deal, not the total sum of the VC fund. And then we have 100 left to split. So first we do a preferred return, then we do a catch-up, and then we do a full carry. And we end up with you getting 20% of those 100 proceeds.
Me as a GP.
Yeah. So that means you get 20 million.
Yep. Thank you.
But then the subsequent investments go sour. And in the end, when you close your fund, the end result is actually the total return of capital was 500 million. And the end result of the fund was actually 490 million. That means that return of the capital was a negative result, minus 10 million that you could not even give back to the LPs. So, those 20 million in carried interest that you got from that first amazing deal,
I have to
give them back.
No.
I want to call them back in the end of the fund's lifespan if I realize that you were entitled to exactly 0 carried interest. You got too much because you get that deal by deal early on calculation, but then the markets went haywire. We had COVID and everything went blank and there was no IPOs, no nothing. So you got too much carry. Then I want to claw it back.
So when we ended up with the real results, we saw that it was negative.
Yeah, you had too much carry. And it doesn't have to be negative, it just means that you got too much carry. It could be a positive, but you were entitled to 12 million, not 20. Then I would claw back 8. But in this case, the problem will be, well, it will be several problems. One will be, what if 4 years ago you distributed those 20 million to you, because the GP is typically a legal person, right? And the fund manager is a legal person. But then you're a partner. You were the senior partner and you had 4 other partners, 2 other senior and 2 junior. And then you had a deal team of 5. All of you get part of those 20 million. All of you get part of that carry. So then, I mean, what if somebody even left the firm? You have to go chasing down individuals in worst case.
Yeah.
And another thing is, most likely you will have paid taxes, so you will have a tax burn-off. And in most LP agreements, where you regulate the right to a clawback, you will say that the clawback is everything but not the part you paid in taxes. So if you got 20 million and you paid 5 million in taxes, I will only claw back 15 million. So at least that's something. But it's not good for me as an LP to have that tax burn off, and it's not good for you as a GP. So nobody wins. And that's why typically you will only have the clawback in the end of the fund's life, because you don't want to go clawbacking too early in case it's not needed because of tax burn off and so forth. So that's part of the complexity. But the reason for the clawback is, of course, that ensures fairness and that the distribution isn't disproportionate to you.
Okay, so how can you how can you end up not having a clawback? I mean, do you need to not get as much paid in the beginning, or be careful with how much you pay out?
If you have the European model, then you will calculate it on the fund as a whole. Then it will take longer for you to get the carry, but you will be sure that when you get the carry, I will have my return of capital and I will have my preferred hurdle rate, and we will do the split.
Yeah.
So then it will be
easier to correct then.
Yeah, it will be less of a chance that you have gotten too much carry. I mean, we can come up with a situation where it has happened, but typically no, that will be fine.
So it can be years apart?
Absolutely.
Oh.
The fund lifespan is 5 to 10 to even 12 years if it's prolonged.
Okay, so that's why you need to be a bit careful.
Yeah.
Well, thank you.
Thank you.
This is so good knowledge. Keep educating yourself. And how do you do that? Yes, you like, subscribe, and share this channel to your network.
And let us know what you want to know more about.
Exactly. And just drop questions. And also tell us about your companies or businesses.
And our favorite sponsor of the day?
Our favorite sponsor is LA Fitness. Thank you for having us today.
Bye-bye.
Bye. Welcome back. If you do not want to see other people get rich and you being left behind, this Venture Capital Masterclass is definitely for you. So whether you're seeking investments, maybe you want to work in venture capital or be a brilliant investor, hang in there because now we're starting to get somewhere. And today we're going to talk about two key giants in the investment world, which is venture capital versus private equity. This is going to be so interesting. And if you're into venture capital or investment, this episode is definitely for you. So stick around because this will be very useful for you. Kat, are you ready?
Hello.
Our business lawyer. Let's start.
So venture capital, this is a masterclass about venture capital.
Yeah.
So we talked about it quite a lot.
Yeah.
We talked about early stage startup investments, a fund with a lifespan of 5, 6, up to 10 years, typically. Investing early in high-risk startups, taking typically a minority stake, like 20-25% of a company, investing into the company. Typically being very focused on the founders, the core team, believing in them and providing support along the way, and seeking, of course, high yield return and high yield exit with quite a short time frame, I would say, within the fund lifespan. Right?
Yep, I'm with you.
So high risk, high reward.
Yeah.
Then we have the private equity players, which actually have many similarities to the VC. They're also a fund with a limited lifespan. They also have limited partners, investors, and the GP, the fund manager, who manages the fund and makes the fund decisions. And they typically have the same waterfall with a carried interest for the manager, the GP, 20%, that comes after the LPs, the investors, get return on their investment. So far, very similar. But the private equity typically focuses on more mature businesses. Typically, so you say it's lower risk, yes, but if it's leverage finance, it can be higher risk also due to that. But typically higher ticket sizes, bigger amounts, and typically they take either all of the company, buy it out, or they at least take a majority stake. And they will most likely want to change the management. So they're not that keen on who's the founder of this big company. Instead, they want to change and put in their own SWAT team, their own management. And they also look for an exit within the fund lifespan.
Okay.
So some similarities and some differences.
Okay. And keep yourself educated. like, subscribe, and share our channel because this is so good knowledge for you. Let's keep on going.
Yeah, we can summarize it for you so you get a spreadsheet of it. Key differences between venture capital and private equity. Number 1, stage of investment. Venture capital, early stage or high growth startups. For private equity, it will be mature, established businesses. What about the risk level? High risk startups may fail. That's venture capital for you. In private equity, it will be lower risk because the companies already have operations. They're more mature, but remember, it can be leverage finance. And the investment size in venture capital will be smaller investments from thousands to millions of dollars. In private equity, it will be larger investments, hundreds of millions of dollars. It can even mean that they buy out a company from the stock market. And the transaction type in venture capital will be investing into the startup. In private equity, it will be a secondary transfer where they buy the shares from another shareholder. And equity stake will typically in venture capital be a minority ownership. And in private equity, it will be a majority ownership. And the involvement in venture capital, it will be strategic advice, mentorship, and networking. In private equity, it will be restructuring, cost cutting, and an active management. And as regards the founders, they will be relevant in venture capital, but not relevant in private equity, since they typically want to set in their own management. And last but not least, the exit strategy. Well, it will be quite similar in both cases, I would say. Venture capital typically wanting an IPO or acquisition, and private equity typically also wanting an IPO or selling it, an acquisition.
So they have some similarities, but also some other things. Yeah.
So for you looking to break into either venture capitalism or private equity, it's good to understand that there are some fundamental similarities. So for you wanting to break into venture capital or private equity, know the differences and the similarities and see what are your key strengths. And if you're a business owner, are you looking to sell your company as a whole, and is it a bigger, more mature company, then you go to private equity. If you're a startup or a scale-up, then you seek VC money, and if you want to stay on and keep working on it.
Thank you. Now we've presented two different ways to fund your business.
Yeah, quick and sweet.
Quick and sweet, and you make it easier for you to choose the right thing for you. Keep educating yourself, and you do that by sharing our channel, like, subscribe, and also share about your business. And we're also featured by the LE Fitness today. And remember, this is not legal advice. As always, it's knowledge sharing, which we are sharing with you for you to gain more insight in this time. So imagine that you are having a high growth startup and you need money and you need it now. What do you do in this situation? Equity financing? Maybe not. Regular or traditional bank loans? No. But what happens if venture lending comes knocking at your door? Imagine no immediate dilution in the company and you get the money. But is it really risk-free and as good as it sounds? We don't know. But today, Kat, our business lawyer, is going to break down the venture lending for us.
Yep.
So you know how to take advantage of that and when you can use it and when you should run the other way. Kat, welcome.
Tack. Hi. Well, let's start directly.
Yeah, it seems like a big thing. We need to go through it all.
Yeah, and it's not as... you don't know about it as much as you do about venture firms, venture investing, right?
Exactly.
Yeah.
I never heard of it.
No. So this is a loan, high risk loan.
And why do you use that instead of other things?
Yeah, it's so fun because if you be careful, if you Google it,
Yeah.
you'll find all of these bank and other institutions offering venture debt, preaching to the choir why it's so brilliant. With, like you said, no dilution. We'll get back to that.
Yeah.
And why it's so attractive for you and how they support startup ecosystem.
Yeah.
Or you look the other way and you find those who only bad mouth it and say it's horrible, stay away, they're vultures, etc.
That's why we have you to like break it down so you can take your own decision.
Yeah, I've been in many negotiations with venture lenders. So to kick it off,
Yeah.
Difference between a bank loan and a venture loan is that if you can take a bank loan, you take a bank loan.
Yeah.
If you're a startup, you can't take an ordinary bank loan because you don't have the security, the assets, or the stability, the profitability, etc. So that's off the market. This is higher interest rate,
Yeah.
shorter duration, typically 3 to 5 years. They often want a kicker. A kicker will be that they will want some kind of equity in your company, typically warrants, so not direct dilution, but some smaller future dilution.
So if I lend you money, I want something back.
Well,
that like the
in
kicker?
addition for,
Okay.
you want the money back, of course, and you want the interest.
But something
also,
extra.
yeah,
Okay.
yeah. So it's a kind of a creative solution. And what also is good to know here is that given that it's, I mean, equity, you can always kind of find out how the structure is set up. You can look at how different venture capital firm works. Venture lending, that's a bit more under the radar, and the contracts are held private. It can be hard to know what's market practice and not, and what's reasonable and not, and how far the lender can push these conditions. And they will have covenants. Super important.
Yes. And what is that?
Because also, if you can, some say, oh, you need that. This is what, because you don't want dilution.
No, of course not.
Yeah, but most often it's because you cannot get an investor. Most often, not
be
always,
honest.
but
Okay.
often. Can be a strategic, brilliant choice in some instances. But in this case, where you're a bit desperate for cash, they will have covenants, which they are typically very, very far reaching. They can be positive and negative. That means that they want to say so if you want to change your business plan, if you want to make other, take up loans, and these you cannot take any loan that will be senior to their loan, etc. And they will typically be very, very far reaching. And if you do not adhere to them, you will need to try to negotiate with the lender, or you will default on the loan. Yeah. So that's a big one. High interest rate, covenants, short duration. And also, when we talk about the high interest rate, do look at the totality. Because there can be very many costs in different layers. So it can be a penalty fee in certain, if you want to pay back early. It can be a fee for the drawdown, taking the loan, etc., etc., etc. So they can be, and sometimes you have an interest holiday. So you do not pay interest in the beginning, but it will be compounded. So you will pay that finally. And that is also, it's a high risk for you if you're not profitable yet. I mean, if you get equity, an equity holder has nothing to say until you are profitable. He cannot say, I want my money back from the company, right? A shareholder stands the risk, whatever happens with the company. A loan provider does not have that same second tier standing. They will demand the interest and the payment back, which means that your startup is much more vulnerable financially as soon as you take up debt, right?
Yes, of course.
Yeah. So more risky to have debt than to bring on investors. And then we did mention it can be good.
Yes, it can be good. But in what situations?
Yeah. So often it comes when you have a VC. A venture lender will not go to give money to a startup that's not VC backed. But let's say that you are scaling fantastically, and you did a Series A funding round here, and you do not want to make a new funding round here because the valuation is okay, but you know that in 12 months your valuation will be here, then you can have it as a kind of bridge financing.
Okay.
Kind of a leverage financing, really, because if you take on loan debt and you have a prolonged runway for, say, 12 months, then that can be a super strategic move for you if you feel assured that your valuation will be that much higher. Because, again, it's leverage finance. So in some instances, but again, also know that one additional downside with venture debt will be that you may be much less attractive for an investor going forward. Because say that you took a venture loan for 5 million with a duration of 3 years. After 3 years, you come to me and say, well, I want an investment of 7 million. And I look and I say, but 5 of my millions will not go to the company. They will go to pay back a lender. Why on earth would I go with you? And that's just I'm giving my money away to somebody who's walking away. It won't help the company. So you might come in a situation where you are less attractive. Because remember, the debt, the lender, will always be prioritized also in front of VC that has preferred shares.
Yes.
So, dangerous.
Yeah, but it feels quite risky to have the short terms. I mean, you have very short time to the company have to grow fast and get money.
Yeah, that's aggressive loan terms.
So you need to be quite bold to do that, right?
Right, absolutely. Or desperate.
Oh, desperate. Yeah. Well, you're quite bold sometimes when you're desperate.
Exactly.
Too.
But like I said, sometimes when you want to postpone the next funding round, it could even be that your VC backers are positive to doing a bridge kind of venture lending finance.
It could be a good start or just to get moving.
Yeah, wow. To leverage it.
So that's venture lending. Yeah. Is there anything more we need to know about that?
Well, I think as regards to covenants, also know that there is typically a cash requirement, which means that if you bring in a VC investor, a VC lender, and you have a pot of 12 million, there might be a covenant saying that you need to have 4 million in cash in bank, so you can't use it.
That doesn't sound so good.
No. So just know that the covenants are far-reaching. Read them through, know what costs and the consequences, because if you default, many venture lenders will have a right to take over the company. Now, they don't want that. They're not in the industry of taking over companies, but they are very rigid. They're hard to negotiate when you're in trouble. So be mindful, read the fine print, because there is a huge variety in the terms and conditions of a venture loan. Very, very big variety.
Yeah, so now you know that for taking out venture lending, read it through carefully and know what you're getting yourself into.
I would say get legal advice, get financial advice. Yeah. Because
this is not legal advice. It's knowledge sharing.
Yeah. So strongly recommend getting good advice before you decide to go with venture lending.
Really good tip. And now you know about this. Thank you so much for watching this episode. This episode is powered by LE Fitness. If you do not want to stand there and watch other people get rich and you being left behind, this masterclass about venture capital is for you. Whether you are seeking investment, maybe you want to work in venture capital, or just want to be a brilliant investor, hang in there, because now we're going to talk some heavy stuff.
Indeed.
We have Kat here who's going to explain everything we need to know. And today we're going to talk about something that's called the rollover, which is a strategy you might heard a lot about, but today we're going to dive deep into that. So stick around, because after this episode you will have more tools in your business law toolbox.
Yep.
Let's get it on. And remember, this is not legal advice, it's knowledge sharing. And today we are powered by the LE Fitness. Thank you for that. Kat, what is rollover?
Yep.
Cool word.
Cool word. And we're going to talk about it in the VC context.
Yep.
So we're going to use it broadly. We're going to talk about transactions where the ownership or the investment beneficiary in some way, shape, or form stays the same before and after the transaction. Messy?
Yes.
Yes.
Very messy.
Let's be concrete.
Yeah.
So we're going to have 4 examples. Number 1 will be a rollover that's typical when you see in M&A, which is where an acquirer, regardless of whether it's a strategic buyer or private equity firm, they ask the current shareholders of a company to not only accept payment in cash, but actually, in part or in whole, accept payment in shares in the acquiring entity.
Okay.
So we talked about venture capital having a limited lifespan,
Yes, exactly.
investing, managing, and looking to exit. But in this case, during the managing of the portfolio company that they have invested in, that portfolio company might get an offer to get acquired. And the VC might think, well, this is early on in the journey, and we believe in the new entity, the acquiring entity. So instead of seeing this as an actual exit of the portfolio company and doing the waterfall distribution, etc., they accept a rollover. So instead of owning in the portfolio company, the VC rolls over the ownership into the acquiring entity.
Oh.
So we will typically not see it as an exit event. We will typically not calculate a waterfall in this instance. We will wait for the bigger exit. And this is, of course, strategic when the VC see that there is much more money to be made in this way.
Okay, and that's why you're doing this rollover.
Yeah. So that's number 1. And that's the most typical rollover also generally in M&A. Number 2.
Yep.
The continuation fund. Because sometimes life happens.
Yep.
So the VC might have 6, 10, 12 years lifespan, able to prolong it perhaps. But at the end of the journey, there can be a portfolio company that it's not ready for an exit. You can't really find one. And it's not worthless. You don't want to liquidate it, just give up. You might see it has perhaps even initiated an IPO process. So you see potential if you stick around for a year or 2 years more. So then you can bargain with your LPs and set up a continuation fund so that the fund, we talked about starting that Stellar Fund number 3. So at the end of Stellar Fund number 3's lifespan, you have this tech company that you believe in, that you see can make an IPO in 1 year, and then you know you will be subject to a lock-in for 24 months. So you need more time to make a great exit. So you turn to your LPs and say, you know what? You want to continue with me into a new fund? And typically the LPs will have an option to say yes or no. You typically cannot force them. But if you get sufficient buy-in, you can set up the continuation fund. You might have to buy some out and continue and then make a grand exit, hopefully. So the downside is poor planning. It might not look too nice. And another downside will be that longer time that you have the money under management, the preferred hurdle rate will tick. So it will cost you more also. And it will be costly to set up a new fund and do the whole structuring. So if you can, you will avoid it. But in some cases, it makes no sense to just hit a run just because the fund lifespan is over.
Okay. And then number 3.
Number 3, that is a close one. In this case, Stellar Fund number 3, you invest in seed funding in tech companies. But you also have Stellar Fund Venture that invests somewhere between Series A to C venture financing, a bigger fund. And you actually like that company.
I do.
So you sit on both sides of the table. So you want to do an exit where one fund sells to another fund within your control. Super sensitive, but can be a brilliant deal for both parties.
Yes.
Of course, challenging because of conflicts of interest. Which is best for you, and will that also be best for the LPs in the respective funds, because they might not be the same at all. So that's a big challenge, how to handle it. Valuation. What is fair market value for that company at that stage? So that needs to be addressed. And this will be an exit. So Stellar Fund number 3, when they sell it to your new growth fund, then that is exit and the waterfall will be triggered.
Okay.
Yeah. Good?
That's really good.
Yeah.
It's a lot of information.
Yeah. So like I said, we're going to go broadly on the rollover concept.
Yes.
Yeah.
Okay. And then we have number 4 then.
Yeah. And that's not so popular.
No, but we have to mention it.
Yeah. In some cases, it can be hard when Stellar Fund number 3 comes to an end to liquidate all holdings. It might not make sense for some reason. There might be some value in it, but there's for some reason you cannot get liquidity. And then you can offer the LPs distribution in kind. That is, instead of getting the cash, money, waterfall, they get shares in kind. They get ownership. They were invested in the fund, but instead of continuing being invested in the fund, they get shares directly in the portfolio company and owns directly in the portfolio company. And that's seen as an exit and not too popular because some LPs might not even be able to hold shares directly in a portfolio company. And they can have tax consequences, etc. You might need to put up a SPV, special purpose vehicle, to manage this.
So that would you say would be the downside?
Yeah. So it's not too popular. It might not make you look brilliant because it can be at least annoying and costly and administratively burdensome for everybody involved. But it is a type of rollover where the beneficiaries, the ones really investing, will be the same, but the holding has changed from being invested in the fund to having a holding directly exposed to that portfolio company.
Okay, but is it common to use the rollover?
Yeah, absolutely. In general, in M&A, doing a rollover, if you're the founder of a company and I come to acquire it, I would often love to pay you in some part with equity in my company instead, because then I don't need as much liquidity. You stay with skin in the game, which kind of ensures me a bit that I'm not, you're not overvalued and the value will drop, because then it will affect you still. In particular, if I want you to stay on and work, etc.
Okay, but as I can understand you, if you take the Stellar Fund as an example, it's only used the rollover when the fund is almost closing.
Except for the first one with the M&A transaction, where you as the manager
exactly
say, I'll stick around.
Okay.
With a new owning entity, like a new portfolio company really for you. But in the other cases, yes.
That's so good information to know.
Thank you.
Well, now you know even more about the rollover if you're into venture capital. Maybe you want to work with it, seeking investment, or maybe just want to be a brilliant investor.
And if you've seen other examples and you want to ask us about them, what does this mean? I've seen this solution. Drop the comments down below and we'd love to pick that up.
Of course. And remember that this is not legal advice, it's knowledge sharing. And this episode is also powered by LE Fitness. And if you want to be the sharpest one in the investor room, well, keep following us and subscribe to our channel, because we're going to share so much business law at zero cost. Stick around until next time.
Hej då!
Hej då!